A very pleasant evening to all my academic learners. Welcome back for the another academic counseling session with me today on the subject business law. So I think it's already 5 minutes now, and we can start with our academic counseling. And I hope that more students are going to join us very fast. I have started the recording, so now you can write your names in the chat box, which goes as your attendance, which will be marked as your attendance. So you just need to write your names in the chat box. Okay, Vasant. Okay, so now what we do for today is we have already discussed about three blocks and few laws or few acts in our previous academic counseling meetings. We have discussed about general overview about business laws. We have talked about certain from where are the what are the different sources from where different acts have been taken. We have also discussed about major laws and acts, that is your Indian Partnership Act and Companies Act. Further, we have discussed in the last class, if you remember, we have also talked about, that was your third block, various also forms of businesses, and also we have talked about the international contract of sale, general principles of contract act. We have discussed various concepts related to the Contract Act. I've talked about what is bailment. We have discussed about how it is different from contract, what are the essentials of a valid contract, and so on. In this block today, that is your fourth block, it has few chapters, few units, that is insolvency and bankruptcy, foreign exchange management and related regulations, and banking and other allied regulations. So actually, the name of the entire block is legal and regulatory framework for financing and investments of business. So the entire block talks about all the legal and regulatory frameworks, which is basically for investment purpose. Last block, what we have talked about was majorly about contracts done in the domestic, at the domestic level, and done at the international level. This is more about financing. This is more about investment. So we will be talking about banking sector more. We'll be talking about insolvencies and bankruptcy. We will also be talking about FEMA, which is Foreign Exchange Management and Regulation Act. So let us start with banking and other allied regulations. That is Unit 7 for you. If as you already have the content with you, if you want, you can open that content so that you can have a kind of an understanding with me. I would also be sharing the content with you. I'll just share my screen so that the content is visible to you. Okay, so is the screen visible to all of you?
Yes, ma'am.
Okay, I have just shared Unit 7 with you. Now, when we talk about banking and other allied regulations, let us first understand few important things, that what are we going to talk about in this entire block or in this entire unit. I will be giving you a brief introduction about evolution of the banking regulations, how they are different or how are they connected with chartering and licensing, what are the different regulations which are related to bank management, and you deal with certain kinds of banking transactions. So what are the major relationships or regulations in relation to bank management, regulations with respect to ensuring liquidity and healthy lending practices. So we'll be also talking about those things. Finally, we'll be talking about the penal powers and the reporting requirements, inspections, and audits. So when I talk about a general introduction, let us start with a general introduction to the entire financial sector. You all might be knowing that it is very important to have a proper regulation of financial sector, But within the sector also, when we talk about the banking sector regulation, that is very, very important. Now, there have been many periods, like you might have heard about the Great Recession of 2018, where it was observed that what the impact it has on the entire economy. So the fragile nature of business model of the different banks and the consequences of bank failures, it has been observed that it is to be taken very seriously, and especially in the recessionary phases in the recent history. So bank not only are the, I would say, institutions which help you for the deposits of the people saving, but they also serve as a very important mechanism which helps you not only to the depositing of money, but also in the payment mechanism or in the withdrawal procedures. So nowadays, as we all, what we do is we go for so many types of credit transactions, we go for so digital banking. What we do today, that has built our confidence to a different level. It gives us so much of relaxations that you do not have to rush to the banks now for your small things, small deeds. But now what has happened is, with all the digitalization, everything can be done at just in a fraction of second. So that is how the entire sector has changed now. Even the human resource which is working there in the banking sectors, we find that they are updated, they are given training, they are made to understand that how they have to deal with the current situations in which the bank is making its future. So all these things, when we talk about, and as I said, the Great Recession of 2018, which was after experience after the Great Depression of 1929, has made things very clear that for healthy banks, you have to understand that depository plays a very, very important role. Because ultimately, if you have supporting, if you have money, if you have financial support in the banks also, then only they'll be able to come out with any kind of a recession if it is happening. So if I talk about what is the evolution, how did this entire banking regulation has evolved. So the first necessity of bank regulation came when it was in the banks, when they started to understand that when you are executing payment, it is very important for certain instructions and to making collections on checks deposited with them. So instead of chasing each bank individually, it was found, or it was thought of, that why not to have a central place where banks of a local area could meet, and instead of paying each check individually to another bank for another bank's customer, and to just have a kind of understanding about the net balance due to each bank to be paid, lets the local area have certain kind of clearing houses. So since check honored in the interim may bounce, and that is a very common thing which happens, it might be due to insufficiency of funds, or it can be because of improper signatures, or maybe because of the purported checks writers not matching. So many reasons could be there. So this clearinghouse membership has become something where it's kind of an informal regulation of the industry, which is dependent on the confidence in the solvency of the banks who meet. So solvency, I hope all of you understand it. Till the time you're solvent, that means your assets are more. Insolvent is when we say the liabilities are much more than the assets. So it was the role of the industry specific bodies in forming these standards so that it becomes common guidance for all its members, and over a period of time to make it more formal, to give them a proper recognition by the courts, and understanding banking industry, that it is one of the very, very important industries. The fragility which is there in the banking sector means that if there is any going to be a kind of a rush in for any reason in the economy, ultimately it is the economy which is going to suffer. So it was very importantly felt in the 19th century, where Bank of England emerged as a lender of the last resort to the English banks. So that was the first decade of the 20th century where the Federal Reserve Bank was formed to be the lender of the last resorts in US also. So as I was just talking about, in India, if we talk about, we have RBI, Reserve Bank of India, which was formed in 1934. All these banks, central banks, which were established, they have actually given a structure, to the entire banking industry. And it is like a bank now, which helps the central bank, which is exercising some control and surveillance over the borrower who has given the overdraft facility. So it is monitoring all the banks at different level throughout in all the country, rather in all the states in the country. So with banks having deposits, if I talk about in India, with the central bank or with the RBI, it has also a role of clearing house operations. So it is basically giving a bird's eye view of working for the financial system and to understand the solvency of the individual player. Here in India, we also have NABARD, which is called as National Bank for Agriculture and Rural Development. RBI is said to be playing a very primary role in regulation of banks because it is a central bank of India which shares the regulatory space and over other bodies. But in case of any kind of agriculture cooperative banks and regional or rural banks, we have NABARD, which has also a regulatory role in its principles refining the body of these areas, or I would say regarding all the agriculture and rural developments. So there are certain amendments which banks keep on doing so that the proper regulations can be made. Recently, the amendments were done in the Banking Regulation Act, where RBI has come up giving a primary regulatory role over these banks and at par from all the other commercial banks. So, when we give those kind of powers to the central bank, it is basically the central government which has given that power under the Banking Regulation Act, which is also called as BRA. with exceptions of the powers over the board and other officers of the bank. So you will, I think till now you've understood that how important it is, to have a central bank in the country, which is basically the one which is monitoring all the other transactions of the public and the private commercial banks which are there. So regulations are very very important. It basically helps you to understand the entire legislation because ultimately the impact comes on the economy. So one has to understand or remember that these regulatory bodies which acquire expertise in certain sectors of the economy, legislatures when formed, they will help to expertise develop these bodies for regulating the allied sectors also. So sometimes it is necessary also that carrying out these responsibility in one area which may require any input or corresponding action in another arena of the economic activity. So that is why we have these, banking and non-banking, I would say financial companies, which are also known as NBFCs. They are different. The deposit of the later are not repayable on the demand, which we otherwise we have it in the banking sector, and they do not act even as the agent of their customers in the payment system, again which we have or which we practice in the banking sector. So NBFCs are basically the non-banking finance companies. So these non-banking finance companies, what do they do? They are basically helping you to deposit a short-term deposit, and they may also there is too much of fragile things which are there because if the lenders to these institutions are banks, then what happens is these regulator of banks become interested in their solvency. So more of the banks form these NBFCs to bypass even the regulatory barriers. That is why sometimes what happens is we also have shadow banks. Now these shadow banks are basically where we are not sure about the solvency of these banks. So for all these purposes, what RBI has was given the regulatory remit was that NBFC sector by the amendment of the RBI Act, which happened in India in 1977, that whenever there is a regulatory vacuum in NBFC sector, that needs to be noticed, and after the failure of many depositories at the NBFC, RBI has understood that to remit and to maintain monetary stability, it is very very important to have regulatory powers in the money market. So that is all about some kind of an overview which I have given you about the bank and the banking sector and different types of bodies which exist. Now, there are certain regulations in relating to chartering or licensing. Now, whenever we talk about these terms, that is to charter or to license, licensing, I think all of you understand what is licensing. Can anybody tell me what do we mean by licensing? For any purpose, what do we require? What is a license? Do you have a driving license, all of you?
Yes, ma'am.
So, what is a license?
Like licensing is like a governing body that is giving license for a particular practice. For a particular practice, like in pharmacy, we have pharmacist license. That a holder of that license is capable of carrying
Absolutely.
poisons and drugs. Yes, and doing some activities related to pharmaceutical services.
Yes, Suleiman, you're absolutely correct. Whenever we talk about a license, it basically means a permission. Yeah, getting registered to a practice. Yes, Akim. When we say that what is a license you have, that means the kind of a permission which is given to you by the central body. If you're talking about driving license, then we get a license from the the different agencies where they give you the permission that yes, now you are eligible and you are having the legal right and you have the permission to drive a two-wheeler or a four-wheeler. So it's kind of a getting of an approval, right? So whenever we talk about these banking regulations, just a second. Those who have entered late, I request you to please write your names in the chat box because your attendance is going to be recorded from there. And the others, those who have written, that is fine, completely fine. So now when we talk about the regulations which are, as I was talking about, the Banking Regulation Act, which is also known as BRA, it gives RBI wide amplitude in granting of license. So RBI in recent times in India, they have come out with a policy paper on how they can exercise this kind of discretions. There are certain conditions for license. License, as I said, it is just kind of granting of license is basically the discretion of RBI only, but still Banking Regulation Act has laid down certain conditions for the exercise of its discretion, and these conditions are basically which is required to be satisfied before you are granted a license. So Banking Regulation Act prevents any person or entity to give further check writing facility to its customer if the person or entity is not a bank. So this is one of those things which I've just listed one of them. Now, before we move on to that, let us understand that what are the different types of banks for which you have different kinds of license which are issued. So at present, banking license for a commercial bank, if we talk about, they are in three categories. That is payment banks, we have small finance banks, and we have full-fledged commercial banks. Okay, so when we talk about these different categories, it is to first understand that commercial loans, while the second, that is the first one. If I'm talking about the first category, that is payment banks, they are basically, not they do not give out any commercial loans. That is your payment banks. Whereas when I talk about small finance banks, they are basically they are allowed to give commercial loans, but they have a certain limit to it, which RBI has fixed up to 25 lakh rupees at present. And these two categories, that is your payment banks and the small finance banks, they are they have a very lower risk, because the licensing conditions are less onerous for them. So it is not that very difficult to get the license of a payment bank or a small finance bank. But when we talk about the third category, that is one of the very important banks, which is called as the commercial bank. They are basically the charters of the management. So the main, I would say, important thing, one change which the RBI has done in the recent policy is that from now on, the bank licensings are to be on a tap provided the applicant meets its rigorous conditions for them. So if you are able to show that you will be able, I'm talking about private commercial banks, where we require these licensing. So you need to show a roadmap for payment banks to progress to small finance banks, and then you get a full-fledged commercial banks. So RBI license is required when you want to open bank branches. It is something where you need to get permission from the Banking Regulation Act, and you have to consider various other things which go side by side. So License basically is granted on the basis of that, you are given that permission to operate certain, I would say, these banking transactions. And foreign banks also want to open branches in India. I think you all are aware about it. So RBI gives them also the license, and by understanding the reciprocity which is there, so Indian banks can open branches even in the country of incorporation of the foreign bank, where from where, the banks, foreign country banks wants to set up the bank in India. So these latest guidelines of RBI also provide that foreign bank also, if they want to start a bank in India, will have to go through a proper subsidiary incorporated in India, as they are actually insulating the Indian limb of the business. So because they are entering into the economy, economy of that particular country. So for any company to be licensed to operate as a bank, it is very, very important to understand the basic regulations which exist. Now, let me share the screen with you, and we'll talk about certain regulations which are related to it. Okay, now when I say the regulations relating to the bank management, basically there are two aspects when we talk about it. The first one is distribution of shareholding and the extent of control that the dominant group of shareholders exercise over the bank. Somebody has unmuted. Please mute yourself. Asad, Asad, please mute yourself. Thank you. So what happens is, the first of all statute denies voting rights to the preference shareholders irrespective. Now let me first tell you that who all are shareholders in a company, banking or another companies. Who are shareholders? My question to all of you, who are shareholders in a company? Yes, you have heard about this word, shareholders, debenture holders in
Yes,
a
ma'am.
company. Yeah.
Shareholder is a person that involved in an equity of the company.
Suleiman, from your end, the voice is not clear. You can write that in the chat box. It'd be easy for me.
Well, it's somebody who has some investments or some capital, or what we can say dividends in an organization.
Okay. We give them dividends. We give them profit. And who all are debenture holders then, Grace? How do they differ from shareholders?
I beg your pardon, ma'am.
Who are debenture holders? How do they differ than the shareholders? Akim, you have written it absolutely right that shareholders are the owner of the company, person with financial obligation that is involved in acquisition of share in the company. Yes, absolutely correct, Suleiman. When we talk about shareholders, as you have said, that they are owners of the company, whenever if there is any kind of, I would say, the payments which needs to be done, profit distribution needs to be done, it is, or I would say at the end of the year, it is first all the other debenture holders, creditors, the other investors, they would be paid first in the company, and then afterwards later you pay to the shareholder, because shareholders are owners. So they are the one, those who swim and they sink also with the company. If the company is doing really well, it is doing really good, so they enjoy that profit. That is shareholders. But they are the one to whom it is, the payment is done at the last. They are the last one to whom the payments are done. Right? So whenever we talk about these banking company depositories, let me just share the screen with you so that it becomes easy. Have you ever studied this topic? You know what we are talking about, like banking regulations. Have you ever studied these areas ever in your graduation? Anybody?
No, no, actually, ma'am.
Okay. And I hope what we have done in last 3 days, you've gone through that particular concept. Have you just, gone through the notes which are available? Have you read some part of it?
Yes, ma'am. I did.
Okay. Okay, so any questions you or any doubts you had in between?
I'm much
Well,
good.
for the last 3 days, all the questions that I have, I already asked and you responded to the question. So maybe, probably during today's lectures, if there is any, I will let you know.
Mohammed, I was not able to hear you properly because of some disturbance which is coming from your end. You can write that in the chat box. That becomes more easy for me also. I was just asking that usually what happens is, as I said, this is a very new subject to you, and I said it is very very exhaustive as well. On the other hand, so I just want to know that after the academic counseling, do you go through those contents which is available to you? Because if you remember, I've said that in the last classes also, that it is more of interactive counseling which needs to happen. It is not where I will be, and not even it's not possible also that I can teach the entire content in the given span of time for like the exhaustive content which is available. So how many of you have referred to what we have discussed in the last 3 days? Just write that in the chat box. Okay, you've written I do. Mohammed, were you able to connect with what I have taught to you or what we have discussed? Was it relatable? Some okay. You write 100%. Thank you. What about others? Farida. You okay? You also write I have. Okay. Are you able to connect with those concepts? My major concern is I do, but only block two, partnership and corporate. Okay. That is very, very exhaustive, also, Usman. It is not that you, I am not asking you, it's not possible also that you study the entire syllabus at a stretch. But the only thing what I feel is because it is law, okay, how they play, okay, businesses and how they play, very good. What happens is, if anything is taught to you or anything is discussed, it is important that you just go through that concept. Otherwise, what will happen, it will become very difficult at the end. So today also what we are talking about, the entire banking sector regulations, I want you to go through it after the class today as well, so that it does not becomes very difficult for you. See, now it is important for us to understand that banking companies depositor, they have to understand that we have to understand that they have various roles to play. They are into the distribution of the shareholding and also to the extent of control to the dominant group of shareholders which have exercises over the bank. So, part of the problem is taken care by the Banking Regulation Act, and some part of the problem is taken care by different conditionalities which are laid down by the RBI while they provide a license and it gives it powers to issue directions to the bank. First of all, the statute denies that voting right of preference shareholders. Now, here we have your preference and equity shareholders. So, equity shareholders are more, I would say, having the ownership as compared to preference. Preference are paid more. Preference are paid before you pay any kind of money to the equity shareholders. So the statute denies voting rights to the preference shareholders irrespective of the fact that they have not paid preferential dividend for 2 3 years or more. So this is one of the very important thing of statutes, that voting right is denied to the preference shareholders irrespective of the fact. So even they haven't paid the preferential dividend for 2 3 years, still they have a voting right to the entire at the time of voting. Second is the case where we talk about equity shareholders, like I was just talking about, preference and equity. No shareholder can exercise voting rights in excess of 10% of the issued equity share capital. So this capping of voting rights can be increased only by RBI, and that too the limit is from 10 to 26%. So no one on his own or in the concert with others can own 5% or more than of the equity share capital or the voting rights in the company without the prior permission of the RBI. These are few of the very important things which are there in India. So I'm talking about from the Indian perspective. Now, these statutory restrictions which are given by the RBI, they are also mentioned at the time of granting license, and it lays down a schedule, a proper schedule for the dilution of the promoter of the banking company. So it is to ensure that individual interest does not get, it gets hindered with the interest of the bank. And as there are too much of diversity also of shareholding and voting powers, so that there is sufficient control, over the dominant shareholder without even being a takeover which may not be the interest of the depositors. So it is very important that there should be certain regulations to be, guidelines to be laid down. So that is where the BRA and the RBI together, they have fixed certain things. The second limb of this is that ensuring good management is quality of management and its context. So good management is what, basically where you have quality of management, you have proper conduct. So for that also, Banking Regulation Act has covered almost every potential control over the management and almost all the aspects of board of directors working which may affect the bank. So these provisions may appear, keep it on time to time. There might be certain changes, but BRA, what do they do? Banking Regulation Act, through these Banking Regulation Act, they try to resolve the conflict of interest between the bank and its board. So it is very important that a banking company is forbidden to lend to any of the director or any person in whom the director may be interested in. So here further it is to note that a bank may not remit any debt due to from a director or any person to whom the director may be interested in without the permission of the RBI. So these are certain things which you need to remember and to understand, that BRA deals with what? It also deals with if there is any conflict which arises. What is going to be the composition of board? What is going to be the majority of the board, where you need to have certain technical expertise. They also decide that how many here. Yeah, again we have some sound coming from the other end. Who has unmuted? Musa, can you please mute yourself? Musa Umar, I request you to please mute yourself. Okay, so that is what I was talking about. That the entire framework has been mentioned, has been listed, that how many people can be there in the board. So, chairman, managing director, then it is also mentioned how do you appoint them, what is going to be their process. Then, according to the articles of association or memorandum, there are certain resolution to be passed by the shareholders with regard to determination, remuneration, appointment of the MDs and people who are at the director or the chief executive officers who are going to run entire banking, take care of the entire bank. So these all are approved by the RBIs. The directors who are going to be the full-time directors, again, how are they going to be appointed? Then again, what are going to be the other compliances of the banking company? If you want to remove the director, then what are going to be certain regulations? All these things are in public interest, for the interest of the depositors, or for securing proper management of the banking company. RBI from their end can always or has the power to remove any managerial personnel, whether he is a chairman, whether he is a managing director, whether he is a chief executive officer, or any officer of a kind, where if they feel that it is not going as per the interest of the depositors. So appointments can be done, dual procedures to be followed, there are going to be certain nominees to the post, so there could be anything, additional directors are required. All these things are to be managed by the banking company. So this control is there, which is in the hand of the central banks. Now, when we talk about these regulations with respect to liquidity and healthy lending practices, I hope all of you know that bank, in addition to the banking business, can only do a business that is permitted by certain permissible sections in BRA, that is Banking Regulation Act. That section is section 6 subsection 1, and that last subclause of the section says the government to notify any other business or activity which a bank allows for the I would say which the bank is engaged in. So what it cannot do directly or it cannot do indirectly as well, so it is to be mentioned in that particular clause, that is your section 6 subsection 1. There are certain restraints on shareholding. There are certain kinds of things which are mentioned regarding the shares in excess, that I was just talking about, certain percentage of equity and preference shareholders. So that is, all these kind of, because of your historical experiences, what banks keep on doing is they try to forbidden the trade in goods and hold immovable properties, where basically for a period of certain time which is more than 7 years. So that is where they keep all these regulations so that everything is under the ambit of the bank's permissible nature. So the object of basically the MOA is that is memorandum of association, that if you want any kind of an change to be done, it needs a prior approval from the RBI. And this is a basic also a caution, which prohibits the bank from entering into any transaction which is based on their own apprehensions. So that is something where the BRA becomes, the Banking Regulation Act becomes very, very indispensable, and there is where they keep the entire control about many things. In addition to giving permission, there are also certain restrictions which are imposed by, again, as I mentioned, certain sections. So here, section 21 under the BRA has laid down certain policy documents which talks about that when you are about for bank advances, or when you are for any kind of the payments which needs to be done, certain margin for security, certain considerations to be done regarding maximum exposure. So banking company, to have an individual company or a group, has to understand certain rate of interest and the condition for the financial accommodation of a borrower. So this is where again what is happening, RBI in public interest or in the interest of the, say, I would say the entire banking policy or the banking industry, they try to manage all these things. So they have a certain Basel Accord norms which we talk about in India, which is basically the pursuance of this power which the RBI has. They have implemented that in the form of the Basel Accord norm, and has given banks guidelines to income recognition. That is a frequent cause of bank failure by suppressing their weaknesses. So NPA, this is which we, when we try to basically understand all these BRA or the banking regulations, it's very important to understand regarding all these aspects, not only about the depositories, also related to issue of shares, also related to certain kinds of demands if happen. So what is going to be the extent of limit and so on. So statutory, you might have heard about SLR. Have you heard about SLR in a banking sector?
SLR, no?
That is called a statutory liquidity ratio. If you want, you can write it down somewhere. These SLRs are basically where the assets are generally government bonds or the bond guaranteed by the government, and they are through few other assets where the government keeps on changing these SLR ratio, and these SLR are fixed by the RBI. So what that is on which rate the banks are going to lend money to the other banks. So subject to the floor and ceiling rates which are prescribed by the Banking Regulation Act, the CRR, which is called as the cash reserve ratio, and the SLR, which is called as the statutory liquidity ratio, they are both fixed by the RBI. And over I would say some period of time, banks keep on changing the CRR and the SLR ratio, where they, like, if they feel that there is too much of inflation in the economy, so the SLR ratios are changed, SLR ratios are increased, so that they can limit to the I would say limit to the purchasing power of people by increasing the rate of interest. So when the rate of interest is going to increase, automatically our credit purchases are going to be not that to that extent where we are actually doing. So repo transactions, it is also another thing which is there in the banking sector, what we study, that we have a repo window which is called as a repo rate. So repo transaction is basically short-term lendings when they are done, sale and purchase of transaction between the parties. So we have to understand that these are three important things which you should know when you're talking about the RBI or when you're talking about certain banking Banking Regulation Acts, that is the CRR, SLR, and the repo rates. So I'll share a few articles also with you where it will be more clear that in banking sectors, when you talk about these repo rate, that is something which is fixed by the Monetary Policy Committee. When you talk about the CRR, when you talk about the SLR, they are fixed by the RBI, and they keep on revising it wherever they feel like that they want to, restrict to the credit purchases which are happening. So to control the inflation, also these are, revised by the RBIs in the economy. Now, another important things come is the audit of these banks. See, reporting requirements, inspections, and audit is very, very important. Now, these are very three important pillars also. That whatever you do, you have to do a proper regular reporting. There are certain statutory audits and also certain kind of regulations, inspections to be done. So there are certain audits, statutory audits, which are done by the trusted auditors and inspectors, and the banks have to maintain the CRR ratio. So when we talk about the banks, when they have to maintain a certain ratio, basically these CRR ratios are minimum cash reserve what the banks should have, while they are lending money to the, or while they are giving money to people in the society, or maybe the different corporations or institutions. So SLR is minimum what we talk about of 75% of the assets in India, equals to its demand and the time liabilities in India. So these are three ratios which are calculated on a given intervals, so that the RBI also is informed about certain compliances. Now, when we talk about the very important pillar, that is, we call that as inspection. So yes, RBI does have certain powers to inspect that what is going on in those other commercial banks. So as I said, it is a central bank, so during inspections, not only the records of the bank are scrutinized, but also the officers and the employees may be examined if it is required under the oath. So auditors are there, we have trained people, we have the centralized auditors who are given that power, who deem that particular power as a public servant under the Prevention and Corruption Act, which is approved by RBI, that you can go for the auditing. Auditing basically means to check. When we are talking about auditing, that means to check the financial health. So this awareness is done through audit. So companies' law provisions with regard to audit are also applicable, which are there with the banking sector also. So the Banking Regulation Act is also certain audit process, which is very similar to of that of a company by the RBI. That on behalf of the depositors, that means people those who are depositing their money, they might be also interested in the audit process to know that where the money is used, how it is going. So that is why we say that these are three important things in a banking sector. Now, when I talk about penal powers are basically those powers which any regulatory power have three components. First is to legislate, that is rule making, then is to execute, and then third is to judicial. Judicial power is to impose penal sanctions. So the third component is as important as of the first two, that is to make a rule and to execute that thing. It is also important to see what is the impact of the first two. So what can the penal consequences be? That if any kind of a guideline, or if any kind of a rule, or any kind of an act is something which is suppressed, or which is not followed, or which is done by the bank, then the RBI can also deny the permissions, can also come up with certain disciplinary setups by the renewal of the chairman, maybe the managing director can be reappointed, or even a bank can be holded to open a new branch. So the second method of penalizing a bank, if I talk about, that was the first area, is that you constitute the core of the banking business and denials are done. That becomes the slow death of the bank. So not immediately, but that another as a penalty, what are you doing? You are denying many things for the bank which they require, and you start imposing certain restrictions on the bank on different type of advances what they want. Central government, if it is convinced on the basis of these inspection reports by the RBI that there is something which is against the detrimental of the interest of the depositors, then they might also fail to comply certain like the I would say the cushion which is provided to them by the RBI. So if the banks fail to comply with the CRR, which is very mandatory for them to do, so then the RBI can also prohibit them in accepting the fresh deposits. So it is important for the commercial banks to understand that the minimum of CRR ratio needs to be maintained. The third way of penalizing is basically when you impose a fine. I think that is something which we, you know, which we actually I would say experience at many times, that whenever any kind of a penalty is imposed, majorly it is through fines. Same happens it here also. The banking regulations, it is a fine on the bank or on the officer. So if they find that there is any kind of a non-observance of the mandated CRR and the SLRs, then they would result in the imposition of certain penal interest of the bank to the extent of short of the required ratio. And in addition, the officers of the bank will also be liable for the fine calculated on the basis of per day the bank was in default. So the penalty is also prescribed to those who are responsible for furnishing this misleading information. So it is very very important. That's the reason why I said keep in why this auditing is very important. If you provide any kind of a misleading information which is against the which is like against the regulations, or which is like furnishing the information which is not required, accepting fresh deposits and contraventions of the prohibitions, then these contravening which are against the provisions of BRA, the court can also take certain legal, in legal ways, certain powers are given to the RBI to impose fines, and which is going to be a very, very huge amount of money on the banks or on the officers. The fourth way of these penal consequences is that the non-compliant bank, that means one who has not fulfilled the regulations, that is cancellation of their license. So if there is any kind of in the audit it is found that the things are not as per the regulation, that is what we call as a non-compliant bank. These conditions, if they are not fulfilled, then the RBI can also cancel the license which is issued by them. Fifth reason, if I talk about, is that wherever the RBI may feel that bank is not, as per the regulations or as per the norms which are set up, then they can also initiate the winding of the banking company. That means the entire banking, company is going to be given instruction that it is going to be winded off. That means it is cannot run. License are going to be cancelled. Acceptance and fresh deposits are going to be stopped. No provisions will be given from the Banking Regulation Act, and they will be seized on many things, and it will be declared as the insolvent bank. That is also one of the major, I would say, uh, you know consequence which the bank suffers. So these are certain, I would say, the penalties which are there. Once you will read all of them again while you are going through your notes, it will become more easy for you. Certain important things which I would like you to learn from this unit is that what is the socio-economic impact of the banking system in any country. So that's a general question which can be asked. You can also be asked about certain role of the central government in controlling and regulating the banking sector in India, which I have already talked about as RBI. And also we call RBI as the banker of the last resort, because they are the ones, those who are responsible for providing financial assistance and guidance to the other commercial banks. That is why we say RBI is said to be the central bank of India. I hope the concept is clear to everyone.
It is, ma'am.
Okay, so let us continue with another unit. Just a second, I'll share FEMA notes also with you, that is Foreign Exchange Management Act. When we talk about FEMA, I would also like to give you an introduction about FERA, that is Foreign Exchange Regulation Act and Foreign Exchange Management Act. There are two different things. FERA is not practiced now. It is that FEMA is something which we practice in India, and it is actually after the, I would say, FERA, the regulations have changed. What are we going to do today in this is, I'll just give you the entire introduction. I was talking about that it is replaced by FEMA. Just a second, just give me a second. Okay, so we will be now continuing with the second unit, that is regarding the FEMA, as I was just talking about. So what we'll do is I'll just give you an introduction about what FEMA is. Let me just share the screen with you so that it becomes easy for you to connect with me. Okay. Is the screen visible to everyone?
Yes, it's visible to me.
Yes, it is visible from here
Okay.
also.
Okay. Let us talk about first what is this FEMA? FEMA is basically an act which has been formulated by the central government to consolidate and amend the laws which is relating to all foreign exchanges. Now, the basic objective of this is while you go for external trade and payments, there has to be certain management or the regulations which needs to be there so that you can promote the development and maintenance also of the market, foreign market, and there is certain kind of control also which is there in the foreign exchanges. When we talk about exports, when we talk about imports, FEMA is basically which is this act is basically which covers many of those things which regulate the foreign exchange rather than managing it. It was when I talk about FERA, that was more about regulation. So that was the, I would say, strict rules which were there in FERA, that was to regulate the foreign exchange by preventing the outflow of the Indian currency, by regulating dealings in the foreign exchange, at times also imposing several kinds of restriction on transaction. So its aim was to only conserve the foreign exchanges and regulate the use of it. But there were number of criminal offenses which has actually was taking place at that time without any kind of arrest warrants, as we say. So in the light of the LPG, that is liberalization, privatization and globalization, government adopted these kind of rules, certain kinds of regulations. So FERA was replaced by FEMA, which was the immediate predecessor of FERA. And here it was where we came up with the understanding of managing the foreign exchanges, not regulating, but managing them. It is more transparent. It basically marks and very clearly identifies all those areas and situations which are required with specific approvals of RBI on its central government. So the philosophical approach was shifted from that of just conservation of foreign exchange to more of felicitation or the facilitating trade and payments as well as developing orderly foreign exchange market. So when I talk about FEMA, the act is of 1999 and it came into force on June 1st, 2000. Okay, very important dates to be marked. That is, the FEMA Act came in the year 1999 and the act was actually passed on 1st June 2000. But usually when we talk about FEMA, we say it is Act of 1999 only. Now, what does this act provide? It gives you a legal framework for the proper management and administration of the foreign exchange transactions in the country. So, whatever legally, if I talk about, as we have been discussing about this only, that regulations are important, proper management is important, administration is important. That is what FEMA is doing, but that is something which we are now talking about foreign exchange. We are talking about foreign market. We're not talking about something which is only for the domestic thing. So here what we are talking about, with the changes in the certain economic policies and with the changes in the objectives of the government, there are six rules which are framed by the central government and 23 regulations which are notified by the RBI under FEMA. We can write that, mark that, very very important. Six rules which are framed by the central government and 23 regulations which are notified by the RBI under FEMA. So let us talk about them, excuse me, about all these things. So the act Basically, it extends to whole of India. It applies to all branches, offices, agencies outside India which are owned and controlled by a person who's residing in India. So now, what are the statutory powers under this act? The act gives the powers to the RBI as well as to the central government to frame and pass regulations and the rules from time to time which are required for the consistent foreign trade policy. So it is a basic legislative and a regulatory framework which inbounds and outbounds investments and tries to facilitate trade and business opportunities between India and other foreign countries. That is what is required also. We cannot limit ourselves only to the domestic, I would say, domestic purchases. We cannot only restrict ourselves to domestic trade. It is very important that foreign trade, foreign market, global market is very, very important. So FEMA, what does it provide? FEMA lays down those provisions which are required for current and the capital account transactions. So RBI has laid down certain important role in this management of the foreign exchange. And what does this act provides? It gives you, again, I would go back to those things what we have done, certain enforcements, penalties, adjudications and appeals also. So if there is any kind of rules and regulations which are applied and not followed, so what appeals can be there? Adjudication is when you have a third party intervention coming and resolving those disputes. That is what is the act all about. You can see on the slide, there are the structure of FEMA is given. Can you see that and can you read that, those 7 chapters? Can you read those 7 chapters which are given?
Okay, ma'am.
My dear, yeah, just read those 7 chapters. Just name of those 7 chapters. Now, what do we understand by this? 7 chapters under FEMA are basically 7 different areas. First chapter talks about a preliminary, that is about the entire structure. Second chapter talks about the regulation and the management of the foreign exchanges. As you can see in front of that, there are certain sections which are mentioned. Section 1 and 2 is basically which talks about an overview. Section 3 and 9 talks about certain rules and regulation. Section 10 to 12 talks about authorized persons who have certain role to play. I'll be discussing that with you. Section 13 to 15 talks about certain penalties. 16 to 35 is more about if there is any kind of an appeal or the adjudication. That is, adjudication is if you have a conflict, how do you resolve that entire thing? And section 7 and 8 is all about the directorate of enforcement, if any. And last is the additional or the extra things which are there, which are covered in miscellaneous 7th chapter. So this includes now the rules which are made by the Ministry of Finance under section 46 of FEMA. It also includes regulations made by the RBI related to subordinates or delegated legislations. There is a master direction issued by the RBI every year for the proper implementation of foreign exchanges. We have DPIIT, which is also called as Foreign Direct Investment Policy, which is basically to discuss about the all the investments which can be done. So Department for Promotion of Industry and Internal Trade, that is DPIIT. I would also like to show you something. Just a second. Uh, when we talk about any kind of a foreign trade, so you can see this Directorate General of Foreign Trade, Ministry of Commerce. Can you see this?
Yeah.
So this DGFT, what do they do? This is Directorate General of Foreign Trade. It basically talks about the entire. See, you can see here Foreign Trade Policy 2023. Again, it is. I hope it is very visible to you, all of you.
Yeah, I can see, ma'am.
Now there are certain things. See, if you want to register for any import or export, you know, then you need to get the IEC code, importer exporter code. So how do you apply for that? See, with digitalization now things have become very easy. What you can do is you can apply for IEC code here. So suppose I want to apply, so they'll ask me about certain registrations which I need to do. I'll do that, and then they'll ask me about which product I want to export or import. Let us just write certain numbers. Suppose this is the number. Suppose I'm typing this, it is coming up cotton spinning machines. So when I will discover this cotton spinning machines, it will tell me about that product selection which I want to do, for which I am looking for the ITC code, that is your import export code. The site is a bit slow. I actually thought of showing you in practical that whenever we talk about any content, see, this is how it opens. Now here what has happened is it is giving me the details about the cotton spinning machines. It is telling me that import policy is free. Okay, if you import in USD, if I talk about the current import in the in the year financial year 22-23, so this was the amount of import which has happened, which is in Indian rupees. If you see, that is 4 crores 78 lakhs 49,786. And same way in this industry or in this area, that is of cotton spinning machines, what is the export amount which is generated? So that is 29 lakhs 97,1706.82. Can you see that?
Yeah, I can see, ma'am.
So it will tell you about the export policy, the import policy. So DGFT is basically a platform which will tell you about what is the current status if you are planning to enter into any product or for exporting and importing. So it gives you a clear idea about the exports which has happened in past 5 years, how the imports have been grown, or what is the area in which you can actually explore. So you can explore, and see, it is country wise also. If you can see what are the top 5 import sources of this, and what are the top 5 export destinations where we do. So Singapore is one from where we import, China is one from where we import, and the percentage, if I talk about of Singapore, it is more, and Turkey is also where we have very little amount of, little number of imports what we do in this area. But when we talk about export destination, we export that majorly to the Turkey, Bangladesh, Indonesia, then we have Honduras, and we have Mexico. So this is how, a person makes up his mind that if for any particular thing, if they are interested for import and export, so the DGFT, that is Ministry of Commerce, they provide you with the entire FTP policy, that is foreign trade policy, and gives you single clearance or understanding about all those things at one platform, making it easy for the importer and the exporter to understand the entire, the trade policy of that country. Is it clear?
Yes, ma'am.
Now there are certain rules which are made under FEMA. So you can see it is, you can read those rules. I'll just come to it is just to know more about it. See, I've already mentioned about this. This is important part. I'll just like to talk about it. FEMA basically deals with free transactions on current accounts subject to reasonable restrictions. capital account transaction, realization of the export proceeds, dealing in the foreign exchange through the authorized persons. I'll tell you more about authorized person, and also it deals with certain kinds of adjudications of offenses if there are any, and the appeal which the importer and the exporters have for certain kind of different provisions. So certain definitions are given in this entire chapter regarding who are those people who are considered as the resident in India. So you can just read that for being a resident in India, you need to reside in India for more than 100 and 82 days during the course of preceding financial year. If you are here for these many number of days, then you will be given that citizenship of India. The person who has gone out of India, stays outside the India, can be for taking, might be an employment outside India, or maybe for carrying an outside India's business, or on vacation, or for any other purpose. In such circumstances would also indicate his attention, can also talk about that yes, I am a person of India, I am a resident of India, but I am out because of these reasons. So this it is not included in this. When you talk about this, it is not included when you are talking about the resident in India. So person has to come or stay in India in either of the cases for taking up, and maybe it can be an employment in India, carrying up in India a new business, or maybe for any other purpose. If a person is here and he indicates to stay in India for a longer period of time, his intention is there for an uncertain period, then also what we do is we give them that consideration of resident of that country. That is how usually it happens also, when you take a citizenship of any country. So first is an individual. That is what we are talking about, a person residing in India. Second is where we say it can also be a person or a body corporate. That means companies or which are registered or incorporated in India. They are also considered as, you know, the they're also given that regard when you talk about, when we mean by persons residing in India. So that can be an individual, that can be a body corporate, it can be an office, branch, agency in India, which is controlled by a person, maybe who is resident outside India. That is also considered any office or branch or agency of India which is owned or controlled by a person and is resident in India. That is also counted as the same. Now here they have given you an example. See, Mr. X, who landed in India on 1st August 2019 to take up employment. Many times it happens, na? People come from foreign country to our country, or maybe we go from our country to the foreign country for any kind of job employment. So for that particular financial year, that is from 1819, he was not in India. So for the financial year 1819, he is not resident of India. But for the financial year 1920, because he has come in the year in the month August. We start the financial year from 1st April to 31st of March. So for the financial year 1920, he was in India for more than, if he was in India for more than 180 days, so for that financial year 1920, he is going to be considered as resident of India. Is it clear?
Yes, ma'am.
Now let me come to the next one. That is what is called as who are authorized persons. The authorized persons are basically those who are into, the authorized dealers, because it is foreign exchange market. So we talk about people, those who are into these, authorized dealing. So they are basically the authorized dealers. They can be the money changer, the offshore banking unit, or any other person who is authorized to deal in foreign exchange or foreign securities. They are regarded, or they're given that particular, I would say, recognition as the authorized persons. We have certain capital account transactions, we have certain current account transaction. Capital is something which is more where you talk about that the transaction which alters the assets or liabilities, more about that side. Capital, assets or liabilities. You can have your contingent liabilities outside India, persons resident in India, their assets or liabilities in India, or maybe the transactions which are referred under subsection 3 of section 6. You will be finding that in these notes. Current accounting transaction basically means anything which is not covered under the capital account transaction and without the prejudice to the generality of the foregoing such transactions, such as payments on interest, such as remittance of living expenses, such as expenses on any kind of a foreign travel, education, medical. It can be also, any kind of a payments which is done for any kind of your current business services, short term banking loan. They are all your current transactions which are, for one time, not too much of recurring in nature. Foreign currency, when we say, that means any currency which is other than the Indian currency. Foreign exchange, when we say, so that means foreign currency which includes foreign currency and also deposits which are happening, drafts which are happening, bills of exchange which are happening, checks which are there, letter of credits which are there by the bank or institutions or person outside the India, but they're payable in the Indian currency. Now, when we talk about the entire FEMA, let us come to very important things here. That they under FEMA transactions are, of different types. As I said, capital account, current account, and all these capital account and current account, they have their own guidelines. So FEMA basically has listed certain kinds of provisions. This act allows any person to sell or draw foreign exchanges or to from an authorized person or a capital account. That means if you are not doing it, any authorized person is doing that, having that capital account transaction, which is subject to the condition which RBI has listed. So in that permissible class or classes, doing that capital account transactions where the limit is already given by the foreign exchange and any condition to which it may be replaced or such transactions, all these central government things in consultation with the RBI gives you the permissible transactions limits and conditions which can be basically accessible. So what are the certain powers which are given to the RBI to regulate these foreign exchanges? Very, very important thing. Borrowing or lending of foreign exchange money, transferring of issue of any security, transfer or issue of any security by a person who is resident in India, outside in India, then export and import or holding of currencies or currency note, transferring of any immovable property, acquiring or transfer of any immovable property in India which is not on lease. So these are few things, which you will read and you will come to know about it. You can write it in your own words also if you understand those core concepts. FEMA has basically laid down the mechanism for acquiring property in India by a non resident and outside India by a resident. So it provides you with what are the different modes in which the property can be acquired outside India and by a resident. That is one area. Then modes of acquiring property in India by a non resident. So if there is a person who is non resident to India and he wants to acquire any property in India, so how he can do that? For that also we call that as overseas citizens of India. So there are certain, again in FEMA we have these different laws related to security, movable property which is situated in India, how it can be done, how these people can do the transactions and so on. So if there is any kind of an acquisition, that means you want to acquire any movable property by a non-resident or to whom also we call as a OCI, then other than agricultural land, plantation property and farmhouse and NRI or the OCI can, what do? They can acquire the way of purchase, they can gift it, they can acquire any immovable property in India by the way of inheritance, that is coming from their ancestors, from a person resident outside in India who has already acquired the property. So this is, few things where the FEMA has given you the clear guidelines on this. FEMA has also listed certain things related to the class of capital account transactions. Now there are certain sections what you need to remember in this, that is classes of capital account transactions of person who are resident in India. Again, there are certain things which are listed out regarding loans, regarding remittance, regarding export and import, certain guarantees, certain foreign currency loans which are raised in India and abroad by a person who's residing in India and so on. So all these things are like, if you see there's examples of capital account transaction which includes equity transaction in any other country. So if you want to buy equity shares, transfer including sale of any movable property situated outside India by a person, that can also be part of the capital account transactions. Now there are certain class of capital account transaction, a person resident outside India. We're talking about this where the person is resident in India. So it can be a guarantee again of a person resident outside India in favor or in behalf of the person who's resident in India, somebody who can do that. Deposits between a person resident in India and a person who's resident outside India. Remittance of certain outside, India, of capital assets in India, that can also be done. So FEMA basically is also to envisage that, save as otherwise provided in the Act, rules and regulations that no person is allowed to undertake or sell or draw foreign exchange or any from an authorized person for any capital account transaction. So that is where they have put up the limit, right? So this is very, very important thing. Same you can read for the current transaction accounts or the current account transactions. Due to paucity of time, I'm moving a bit fast with this. I'll just come to important things in this. This is, I'll come to the appealed people or the adjudications or the authorized person. In authorized persons, this is very important. They can be authorized dealers, they can be offshore banking units, they can be called by any other name. They are basically authorized on behalf of the RBI to deal in foreign exchange or foreign securities. So in FEMA, we have few of them, those who have the legal permission to become authorized dealers, money changers, offshore banking units, and they are basically doing this role on behalf of the RBI to deal in the foreign exchange or foreign securities. RBI at any time can revoke the authorization of these people for the public interest, and these authorized dealers, if they fail to comply any of the conditions which is given to them by the RBI, their again authorization can be cancelled. So before revocation, suppose that is getting revoked means taking back, the authorized dealer have to give a reasonable opportunity of being heard. That means if you're withdrawing their license of authorized dealers, the RBI has to give proper reasonable time so that they can be heard before their entire powers are getting revoked. So what is the duty of the authorized person? He shall deal in dealings of foreign exchange. That is one and very simple. But if it is without the prior permission of the RBI, authorized person shall not engage in any transactions. If done so, it is again going to be cancellation of their powers. Before undertaking any transaction in foreign exchange on behalf of any person, authorized person shall not engage in any transaction of another person, and they are authorized to do it from the RBI or the central government. So they need to comply those rules. They need to make that person very clear. They need to make all kind of reports and submit that to the RBI. RBI may give any direction in regard of making payment or doing any kind of desist from doing any act relating to foreign exchange or foreign security also to the authorized person. So the RBI may also direct these persons to furnish such information wherever they feel or wherever they require to. Further, you can read out the different type of penalties which are there. It is very easy. Once you will go through them, you will come to know about it. Very important thing is provision for appeal. See, appeals can be done if there is any kind of violence of the rules which are there, which are not followed. Then you can appeal before the special directors. That is called as the appeal against the order of adjudicating officer. Appeals can be done before the appellate tribunal, which is against the order of the special director, and appeal can also be done before the High Court. These are three appeals which can be done, and very important also in the entire FEMA. So, three important things which are there is here what you need to study is authorized persons, their powers, their duties. You need to study appeals. You need to study also in the beginning what we have done, that who all are given that particular position to do such roles. That is resident of, I was talking about individuals, I was talking about companies. So that is what is more about this part of FEMA. Okay, the more you will read it, the more the concept is going to be clear to you. I hope it is clear till here to everyone.
Cheers, ma'am. Thanks.
Okay, so proceeding towards something which is related to insolvency and bankruptcy, let me ask you now, what do we mean by insolvent or a bankrupt, person or bankrupt organization? Anybody who can write that in the chat box for me? Yes, anyone? Have you heard about these words? Bankruptcy or insolvency, when a person is unable to meet its obligation. Yes, absolutely correct, Vasant. So we call that person as an insolvent, as a bankrupt, right? So when you talk about these insolvencies, and we are talking about banking, financial institutions, we're talking about a proper, the legislative framework in India, the corporate solvency legislative frameworks in India prior to 2016. So that becomes very important to understand that what are certain rules. There is a proper act of it which is called as the Insolvency and the Bankruptcy Code 2016. Certain pillars of institutional infrastructure are there under the IBC, that is Insolvency and Bankruptcy Code. We have certain corporate insolvency resolution process, so we need to go through that. What is the process of liquidation under IBC 2016? What is individual insolvency? What is cross border insolvency? And there are also certain leading examples or cases which are mentioned there. The bankruptcy is when the company fails to pay his obligation. Yes, Usman, it is absolutely correct what you have written. Let me share the screen with you, and very quickly I'll just share these details with you. So, this entire unit, just give me a minute. Okay, so let us begin with the insolvency as I was just talking about. That what are we going to do? By the end of this unit, what you study, there are concepts which are mentioned regarding insolvency. I was talking about, if you remember, IBC 2016, that is Insolvency and Bankruptcy Code. So, what is the Unified Insolvency and Bankruptcy Law? There are certain leading cases which are given. What is individual insolvency? What is cross border insolvency? What is the entire liquidation process? How does it goes? As we talk about that, the liabilities are more than the assets, so there might be certain process or procedures which are followed by the law. So this is a unit which will explain you about the entire mechanism related to corporate insolvency resolution process, which is in India. When we talk about it, as I said, in India, we have Insolvency and Bankruptcy Code 2016, which actually adopts, or which is basically formulated to examine the need to adopt the insolvency, wherein it is, why it is required, when it is required. So the effective and the efficient insolvency regime basically aims to achieve the key objective, which are determined below, like to provide, let us talk about the first one, that is to provide certainty in the market. Because if the person is insolvent, it is very important to declare that thing, so that there is a kind of a balance between the liquidation and the reorganization. Otherwise, it is what will going to happen. The insolvent person, if he is involved into many such things, then it is going to be a loss to the economy also. So the entire insolvency regime tries to strike a balance between this to ensure equitable treatment of the similar situated creditors, to give them timely, efficient, and impartial resolution of insolvency. So, what is an insolvency? When a debtor is generally unable to pay its debts as they mature, or even if liabilities exceed the value of assets, we call that as a insolvency thing under the definition which is given by the UNICITRAL, that is the United Nations Commission on International Trade Law. They have mentioned a definition on insolvency, which in the context of UK Insolvency Act of 1986 have also written. You can read out what that particular thing is there. I'll not read out, that's a very big paragraph. I'll just move on quickly to what is the CLF or the insolvency legislative framework in India. Prior to 2016, if we talk about India, had a patchwork of insolvency courts and tribunals where if there are any kind of conflicts or multiple proceedings that have been arisen, so what they used to do was the complex web of laws, which was recently passed at that time, has regarding the bankruptcy and insolvency. The first one was regarding the Companies Act. We have already talked about it. So the Companies Act 2013, this act basically has certain insolvency resolutions, that if there is any kind of insolvency which is happening, so how do you restructure, rehabilitate, or reorganize the entities under this act? So authority is the national, I would say, company law tribunal, that is NCLT, which contains certain sections, certain principles regarding all these kind of insolvency, and it is mentioned under chapter 20. Companies Act of 1956, that is the Formation Act of Company, also has dealt with the winding up of the companies, where they have mentioned that no separate provisions should be there through mergers and acquisition, that is M&A we say, and voluntary compromises. Adjudication authority basically is going to be the High Court. So if there is no separate provision of restructuring, if there is insolvency through mergers and acquisition, then voluntary compromises should happen, and where the High Court can take the decision. We have various Sikh Industrial Companies Act also, which is called as SICA. This is basically an act which is done for restructuring of distressed industrial firms. So those industrial units which are Sikh units, so how do you try to make them, I would say, viable back again, give them that kind of different ways in which the detection is done first, that they are industrial Sikh industrial companies, and how can you come up with certain kinds of remedial ways and other ways for such companies, that is covered under SICA 1985. Then we have Recovery of Debt Due to Banks and Financial Institution Act 1993. And the last thing, as you can see, is something which is written as the SARFA ESI, which is called as SARFA ESI 2002. All these were basically established, these laws were basically established to have certain procedures, so that if there is any insolvency, how does the entire matter, or how does the entire issue is addressed, and finally the appeals made and resolved. Sika, as I was just talking about, that is about the Sikh units, industrial companies, their net worth is eroded, 100% are identified as being in distress and referred as by BFR. So the BFR must investigate first that what is the potential viability of that company, and then recommend these rehabilitations in front of the High Court for the winding up of companies. So certain issues are listed there. You can read that part and you'll have an idea about it. After 2016, Unified Insolvency and Bankruptcy Law was passed, that is called as the Code 2016. That is basically done so that an effective insolvency regime may be followed and should be understood that this is a critical component of ease of doing business in India. So this code is considered as the biggest economic reform, next only to the GST. GST is also one of the very big reforms which have happened in India. But this is basically an insolvency regime which is expected not only to facilitate easy revivals and rehabilitations, but also, to understand that companies in the financial trouble should be given effective ways in which they can safeguard the interest of the stakeholders, because there are many people those who are involved in that company. They can be the creditors, they can be the shareholders, the government, and with all these things, ultimately if the company is becoming insolvent, it is a loss for so many people those who are connected with it. So It should ensure that these financial resources of the country are utilized in the effective manner for the overall growth of the economy. So that is what IBC 2016, when you will go through, you will come to know about that to give a fresh start and to have an insolvency resolution. Clear and coherent speedy procedures are to be identified so to resolve that financial distress. Debt recovery tribunals and national company law tribunals are formulated to deal with these cases of insolvency so that bankruptcy process in respect of individual or partnership firms or even the companies becomes very, very easy. The establishment of these insolvency and the bankruptcy board in India is basically to have a kind of a regulatory oversight over these insolvency professionals, and agencies are basically formulated to give you information regarding the entire bankruptcy process. So enabling provisions to deal with the cross border insolvencies, enabling different ways to collect, collate and authenticate and disseminate this information to be used in insolvency, to come up with such kind of agencies which helps in the proper insolvency if there is where the debts are more than the assets. So four pillars of the institutional infrastructure under IBC are: first is your insolvency professionals and the agencies which help you. So we have the IP may hold resolution professional, which is called as RP, the bankruptcy trustee, a liquidator, that is in the firm liquidation process. Bankruptcy trustee is an individual bankruptcy process, and resolution professional is basically to resolve the insolvency of a firm or an individual. Second is information utility. This is basically a kind of a second pillar of the institutional infrastructure, which talks about creating and storing financial information so that it is universally accessible to meet minimum services quality standards which are given as per the regulation. Then to provide these access to the financial information so that it can be used to access such information when and where required, to publish certain statistical information again which is specified by the regulation, and have a proper interoperability with other information utility. Third important thing in this is adjudication. The adjudication, I've already informed you that it's some very important area which basically talks about resolving conflicts and disputes. So the adjudication authorities are the third pillar of the institutional infrastructure. We have NCLT, which is a forum where insolvency or the corporate persons will be heard, and the DRT is the forum where the individual insolvency will be heard. So if it is insolvency related to a person, it goes to DRT, and if it is related to a corporate, it goes to NCLT. These institutions basically helps you to come up with a separate affiliate body. So NCLT and DRTs are given that much of strength to achieve the world class functioning of the bankruptcy process. So how does it moves? It goes as if you are a company, so it goes to companies and LLP, then you go to NCLT then forwarded that to NCLAT, and then finally if you're not still not resolved, that particular case is not resolved, it goes to the Supreme Court. Individual cases, what happens if for partnership and individual firms, it goes to DRT, from DRT it goes to DRATs, and then if it is not, they are the appellated bodies, these NCLAT and DRTs. So they finally, if they are not able to resolve, that case goes to the Supreme Court. That is what is the entire adjudication, entire process, how does that goes, right? So the debt DRAT is basically, children, my dear learners, debt recovery appellate tribunals, which are basically those appellate which helps you to understand how the debt recovery on the question of certain codes or laws can be. So there's a time period for it, 45 days. If the solution is not given to you and you're not satisfied, then you can always wait till 45 days, and then the matter can be passed to the Supreme Court. Then we have the next fourth pillar as insolvency and the Bankruptcy Board of India, which I have just mentioned, IBBI. This is which is also where we talk about the central government has been given certain powers. So now when you talk about all these appellate bodies, you talk about all these adjudication process, central government is also having certain powers to designate the financial sector to perform certain functions. What are those powers? They can have the insolvency professional agencies, they can have insolvency professionals, process, and they can have certain information utilities which is important, for the people, those who want to refer, if there any such information where they feel that the company as an individual or the corporate is going into losses. So this is, all about the details regarding the, I would say, the things what we have discussed related to the banking and the financial sectors. So this is why and what it is all about, how it is started, how it has working, what are the different types of moratoriums which are provided, what are the different ways in which these kind of things can be actually proceeded, how do you get approvals, how do you get various approvals by NCLT. So it's entire process is mentioned in this. You can read that. How do you move on to the national law appellate tribunal, what is the liquidation process. Now when I talk about liquidation process, please understand that liquidation order under this code is only passed where the corporate insolvency resolution and no resolution plan can be passed within the time provided for that particular thing which is combined with. So liquidation is basically on the proceedings, that means winding under the company tax. So if it's a liquidation, that means the company is getting winded. So what are those important things which are considered under liquidation? That is all mentioned in your notes while you will be going through that. Public announcements are done where an order of liquidation is passed by NCLT, which is a clear understanding that the company or the corporate debtor is in liquidation. So there should not be any kind of further financial transactions which should be done, because they're already insolvent, because they're already having much of liabilities more than the assets. So to protect the all interest of all the persons, publicly these announcements are done, so that the liquidation, or it we call that as a liquidation order, that liquidation order is passed to that, safeguarding the rights and the, I would say, the financial resources of people in general. So this individual insolvency code, that is 2016, that is also where we, as I was talking about, that the individual and corporate insolvency codes are there. So that is where you basically try to understand that what is the process about it. So what is the amount on which you say that okay, now they are declared as insolvent, or the code which is prescribed, there is a time limit for it, certain percentage is given where you say that if it is lacking with that percentage, then we say, so what is the fresh start after that. So DRT, that is the debt recovery tribunal, has certain kind of discharges from certain debts, and then what is the threshold amount for that, to for a new start, for a start new afresh, what is the eligibility of a fresh start. Usually if we talk about, if the gross annual income of less than 60,000 with assets of value which is not exceeding 20,000, value of qualifying debt of such individuals or partnership firm can exceed 35,000 as well. So they can be given a fresh start to start their businesses, right? There, same we have cross-border insolvencies also. There are two sections which basically deals with it. That is section 234 and section 235. Central government has given certain kinds of rules, which deals with certain agreements where the government of any country outside India, for enforcing these provisions of code by notifications on the official gadget, or maybe by the direct application of provisions of code, can inform that if there is any kind of the insolvencies or any kind of these reciprocal arrangements which are happening, so the subject to the condition which are specified. So there is a letter of request to a country that in course of insolvency resolution process or liquidation or bankruptcy, the case, whatever is the case may be, the resolution professional, the liquidator, the bankruptcy trustee, or whosoever's role is it is, they can give their opinion of the assets of the corporate debtor and include a personal guarantor also of a corporate debtor which are situated in a country outside India. So if you talk about section 234, it gives you a provision about how to make an application to NCLT or DRT. I've just talked about it. If it is individual, how do you go? If it is a corporate, how do you go? And on the receipt of such applications, then the NCLT may issue a letter of request to the courts or to the authorities of such countries to have a competent dealing with such request. There are certain cases which are mentioned in those notes. I would request you to go through those cases. That is one I'll just refer of IDBI Bank, which is against the Lanco Infratech. This is basically a case of 2017. In this case, the NCLT has denied the appointment of interim resolution professional, that is IRP. On the ground, they felt that he is already handling three big assignments and has recently been appointed as IRP. So that was something which we call as interim resolution professional for two large company. So that is here. See, we find that there is kind of, you're appointing people, you're asking people to come up to resolve those things, but it is ultimately the Supreme Court which gives you that, central court which gives you that power to go ahead with that. Surendra Trading versus Jubilal Kamlappat Jute Mills, also there was a case of 2017 which states that certain issues were there regarding the consideration of Supreme Court with regards to relaxation of time period which was given by IBC. So here again the NCLAT held that such time period is directory in nature. So whether the time limit of 7 days prescribed under the code for rectifying or removing defects in the application filed by the creditor for initiating the CRP is mandatory. So the Supreme Court has given an order stating that in a given case where it might be weighty, valid and justifiable reason for not able to remove the defects within 7 days, hence this is to be a merely a directory provision. So they have given that particular permission also, that wherever it requires, they can go for those decisions at the Supreme Court as well. Yes, Suleiman, there's a major difference between insolvency and solvency. Insolvent is a person who's not able to pay the debts. Solvent is a person who is just opposite of, insolvent. He has more assets than the liabilities and is capable of entering into any business transaction, rather than a person who is lacking with those financial resources. That is why we are terming him, or we are calling him that, as an insolvent or a bankrupt. Okay. So that is all from my side for your fourth block. I hope I was able to explain you few concepts related to it, and I was about to clear a few things regarding giving you a guideline about how do you need to go ahead with this entire block. Um, it was a wonderful time with you all having the online academic counselings, and I hope that we are going to meet very soon, probably for the remaining two blocks which are there. So ma'am is going to inform me, and the timetable is going to be shared with you along with the link. So if we are given those those slots, I will be meeting you again for the two remaining blocks of your business law. Any questions, any doubts, anything which you want to ask, it is open now for you all. Thank you, Kameez, for writing that for me, that you enjoy my counseling. It's a great satisfaction. Thank you so very much. Requesting all of you to please let me know if you have any queries. Otherwise, we will be ending the academic counseling here. Thank you once again for being such a good and patient listeners, because that is very, very important. And always being so very active. Wherever I ask you anything, you're always on, with me to answer me those concerns. That even keeps my morale also very high. Thank you so much.
Thank you very much, madam. You're
Thank
very
you very much.
knowledgeable about the module.
Thank you, Grace. Thank you so much.
Yeah, thanks a lot, ma'am.
Thank you.
Thank you, madam. Thank you.
Thank you, Akim.